Welcome to the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello and welcome to the Smart Investing Show. I am Brent Wilsey, president of Wilsey Asset Management. Great to have you here today. Gosh, we got some good topics to make you a smarter investor. We're going to start off with the job market remains a good spot. That just came out on Friday, so we'll talk about that. And there's some good numbers here that are not too good, but they're good numbers. We'll explain that. Also, I was surprised to see this. Office space may be harder to find in coming years, and that could be a potential opportunity for investors. We'll discuss that as well. And then this surprised me, didn't surprise me, but Facebook scams, they're out of control. And really out of control. And sometimes I have wondered, Facebook, we got, 3 billion people watching it. I think a lot of it are like false ones, and there's more to it.
I mean, it's a whole new industry. I mean, relatively speaking, it is so new. So we'll kind of address that as it comes. And, as always, we've got some great companies to look at. We're going to take a closer look at Salesforce. We're also going to look at the Gap, the retailer. There's the company. I was thinking we always talk about Gap earnings. That's not it. We're talking about Gap, the retailer. And then we'll talk about Wells Fargo, some interesting news there on their asset cap that just got lifted. And lastly, the last company we're going to look at is Steel Dynamics. So got a full show here. Got a couple different types of companies, so we're excited.
Yeah, some big things in the steel industry, which we'll cover. But let's talk about the jobs market, because it does remain in a good spot. And give you some numbers here. The headline non-farm payrolls increased by 139,000 in the month of May. That was above the estimate of 125,000. But it was below the reading in April, which is 147,000. So it looks like the jobs could be slowing down a little bit, but not in a terrible, the ADP report on Wednesday really scared us.
Yeah, I mean, it is so hard. I feel like I say this about other things too, but there's all this news that you get, and I don't want to say you want to ignore them, but I talk a lot about the soft data, which is the surveys and stuff. I definitely take that with a grain of salt. The ADP numbers also very strange. That's all over the board. I don't know how much I want to rely on those numbers as like a strong indicator. It's out there. You want to read it, but I wouldn't be like, oh my gosh, the economy's crashing because the ADP said so. And also, too, another one is the household survey. I know that had some bad numbers here for the jobs report. I think it showed a loss of like 600,000 or something crazy. I don't like that one either, because I've never personally been called about,
Never have. And I've talked to people, no one that I know has ever been called.
No. So, I mean,
maybe
how strong of an indicator
say,
is that?
I got called. Maybe somebody will tell us they got called.
Yeah, I mean, but we post this stuff and nobody's ever been like, no, actually, I have been called. Nobody's commented. Nobody's told us. I mean, it is just so interesting to kind of see that. And the thing that I also look at with this particular jobs report, as I said, good numbers, but also there are some question marks. The big one is March and April. Did see negative revisions that caused payrolls in those months to decline by a combined 95,000 versus what was previously reported. So, I mean, that's a little bit of I'm going to say a negative there. But the thing I look at is the fact that we've added so many jobs. I mean, we've talked about this before. I mean, we are still at a very healthy employment level, considering the unemployment rate remains at 4.2%. We've talked about this before, but you're not going to be in a utopia where unemployment is zero.
Right.
I mean, I'd be hard-pressed to believe we'd even go sub-4.
We were at 3.738, I think, in 2019, I believe it was. I believe there was a time. I know we were sub-4 for a little bit.
I think from today's levels, though, I don't think we're going to go sub-4.
And I do believe 4.2 is pretty much what they call full employment. There's people that just don't want to work. No matter, you can pay them a lot, not going to work. So.
Yeah.
But the economy, it is still adding jobs at a healthy rate, given the fact that the unemployment rate is still at, we just talked about it, still at 4.2%. So that's a good number. It's not scary. It's a good number. A lot of people working.
Yeah, and the other thing, too, that you got to understand here, I mean, we talk about the government as one of the major industries, major components of this report. And we know that at the beginning of the year, Doge, and we're not going to get into the whole Trump-Elon battle here, but we know that Trump and Elon wanted to pull back on the government payroll situation. We're starting to see this finally kind of impact it, because government payrolls did decline by about 22,000 in the month of May and are now down by 59,000 since January. So having that negative impact from the federal government and still seeing good positive growth from the private sector, I think, is so important. And we're going to need to continue to see that, because I think we're going to see the losses accelerate in the government payrolls, because you can't forget this. Employees on paid leave or receiving ongoing severance pay are still counted as employed. And I forget the exact details of it, but I want to say a lot of people were on like paid leave essentially until October, November. So I'm very curious. Come October, November, we're going to see a huge spike in the losses in government payrolls, because that's when all the people will now be officially released.
Release. And I thought it was September. I could be
You
wrong.
could be
too.
right.
Yeah,
I don't remember the
September,
exact
October.
month.
But now, hopefully, these people that got laid off there, they're getting new jobs. So when that deadline hits, whether it's September, October, it's not going to be, oh my gosh, a million jobs, in the payroll, because they're already working somewhere else. That'd be the smart thing to do, because you're getting paid anyways. Why not go get a job and get paid twice?
I was thinking the same thing. I was like, wow, this is like a golden ticket. I mean,
Yes.
you can use your skills, go find another job, get paid.
Max
twice.
out your 401k,
Yeah.
your IRA.
But I don't know. I don't know if a lot of people think that way, or a lot of people are going to retire in, let's say, 2026. I mean, shoot, you could have retired basically a year early.
Yeah. Oh, yeah. Yeah, that would make a big difference. So we recommend, if you're a government job, you're not working, go get the job now, collect 2 paychecks at once, and put that in your 401k, invest it. You'll be able to retire earlier is what will actually happen maybe. On the private side, healthcare did add about 62,000 jobs, and leisure and hospitality, I was surprised on this. They did add 48,000 jobs in the month. Because I thought things would kind of slow down a little bit. That's what you keep hearing, but it is not happening. People are still going out to restaurants and bars. Many of the other industries saw little change, but these 2 industries still growing at good numbers.
Yeah, and I think you're going to continue to kind of see this. There is uncertainty. There's no denying that with all the tariffs and kind of changes coming to the economy. The positive thing is you're not seeing huge negatives.
Yeah.
I think that was a big thing that people needed to see here in this report. And I'm glad we saw that. We didn't see like business services lay off 50,000 people or anything like that. I don't want to say lay off, but lose 50,000
Right.
payrolls. And also, too, you brought this up, but I really want to hammer it home. You're not going to be adding 48,000 people to leisure and hospitality if people aren't going to restaurants, aren't going to travel. You need to staff up if there's more people there.
Yeah.
So, I think the economy, just another indicator, is doing just fine.
And I think that would be one of the first things to go if you kind of tighten your belt.
Yeah.
Well, we can't go to dinner tonight. We probably shouldn't take that little vacation. So that's no sign of that.
And also, too, the restaurant industry, I mean, it's a harder industry to staff. So, it's a lot more variable in terms of, needing to add people or subtract people. You are going to need to add more people when you have more people coming to the restaurant. So I think this is, another good indicator. And also, too, people talk about, the pay for jobs. I mean, we're still seeing pay grow, I'm going to say, at a good rate.
Yeah.
I mean, average hourly earnings, they were up 3.9% compared to last year. That was above the forecast at 3.7%, and also, too, last month's reading at 3.8%. And the big positive I see here, 3.9% is, I'm going to say, a healthy level. You're still seeing a nice increase to your paycheck. It is now above inflation, so you're having real earnings growth, but I don't think it is pressuring inflation too much. It's not like it's a huge cost increase to employers where now they have to increase their price of goods and services at a drastic rate. So I see 3.9% as a healthy rate for wages to grow.
And one thing, too, about this jobs report, it was a good report, but not so good and not so bad. I still think it puts no pressure on the Fed to say, we don't need to raise rates or keep them the same. We can maybe still decrease rates at the next meeting. Do you know what it is? Is it?
I think it's June. I think it's coming up here.
Weeks,
yeah, and I don't think they will. I know Trump came out and said he wants to lower them by a full percent. That's definitely not going to happen. But I look at it and say I think listening to a lot of these Fed governors, they're on wait and see until these tariffs pass, and I think that might be a mistake. I think they could go 1 or 2 times because underlying inflation doesn't seem problematic. The employment situation, it's starting to slow a little bit. You might need to juice the economy before employment does fall. I understand where Trump is coming from. I think 1 full percentage is a little bit crazy, but I think moving a little bit wouldn't necessarily be bad.
And one thing I'll argue with him on, he goes, well, Europe's decreased them, 7, 8 times, and we've not done it?
I think 10.
10 times, okay. Their economy is so much worse shape than ours is. That's why they're doing it. We don't have to yet. I don't want to miss the opportunity, but it'd be nice if they did. But I think we'd also wait a little bit. We'll see. There was another report came out. I forgot what it was. So I thought, that could be another one that would reduce inflation.
Yeah.
Yeah, inflation was pretty good. 2%. We're not talking about that? Oh, you talked about that
I
last
talked
week.
about last week.
That's right.
That's what happens when you miss a week. You miss some good content.
Okay, I'm going to cancel all my vacations the rest of my life. Okay. Let's talk about the JOLTS report, known as a Job Opening Labor Turnover Survey. Job openings did increase by 191,000 from the month of March and totaled 7.4 million jobs. This also be the expectation of 7.1 million. We did see a turnaround because this was declining. This is a turnaround, additional 300,000 jobs from last month, because I think we had 3 or 4 months where it was constantly declining from very high levels, I will point out.
Yeah, I mean, you're going to have, obviously, it's not going to go down in a straight line. So you're going to have that variability. But you look year over year, job openings did decline by about 228,000 or about 3% compared to last year. But the thing that we still look at as, I think, a very big positive is the fact that there are still 1.03 available jobs for every unemployed worker. So, I mean, the jobs are still out there if you want one.
Right.
I think that's a big caveat, though.
Yeah. And that is, we could get to zero unemployment because there's enough jobs out there to do that. But there's people like, I don't want that job. No, I don't want to do that. No, that's not paying me enough, whatever it may be. So.
And I forget the numbers, but I saw it today in the report. And I want to say something like there's 1.8 million people that have been unemployed for like what they call long-term unemployed, where it's been unemployed for like 12 months or longer. And I'm like, I mean, you can find a job if you wanted one. But, I mean, they might have a nice pension. They might have a nice fallback in terms of assets. They might be like, I don't need a job. I'll just kind of put myself out there, and if the right one comes along. But to me, that's not bad for the economy.
No. And as with other hard economic data, the next few months will be more telling about how the tariffs are impacting businesses and the decisions. This JOLTS report was from the month of April when tariffs were just beginning. So we're going to see about a month from now, we're going to see really true effect from the tariffs. And actually, I saw today that I guess the president sent out to all our partners, okay, clock is ticking. You got about a month before tariffs go back up again. So,
I know it'll be interesting to see, and this is kind of where, again, we're not short-term forecasters. I'm not going to guess what is going to happen here, but I'm looking at saying there's no denying these tariffs are going to play out in the data.
Right.
That is going to be coming. We're starting to see little inklings of it, but I really think this month, July, August, and especially if there are changes to it, if the partners don't start negotiating, that is, again, where you can really start to see even more variability in the stock market, in the hard data, the economic data. So, I mean, we'll have to keep our eyes open. I don't know what's going to happen. I can't predict what Trump is going to say today or tomorrow, and then how he's going to act with our partners. So we'll kind of have to take it as it comes.
If you could predict that, you'd be a very wealthy man, because nobody has been able to do that. So, but let's talk about.
I don't even think Trump can predict what he's going to say tomorrow.
He is real, because he says what's on his mind, and it could be different today than tomorrow and the next day. So that's why you never know. It keeps everybody guessing. But let's talk about office space, because this could be something good for investors. It may be harder to find in the coming years. Now, why is that? Well, for the first time in at least 25 years, office conversions and demolitions will exceed new construction, which means there'll be less space available. Remember, supply demand. CBRE Group found that across the largest 58 U.S. markets, 23.3 million square feet of space will be demolished or converted to other uses by the end of the year. And I was surprised by this. 12.7 million is going to be completed or developed in those same markets. I mean, that's about half.
Yeah.
That's a good thing for investors, because you want things that are in short supply. And I would say, look ahead a few years, we're going to have, I believe, an office rate problem.
Yeah, and I think this is, again, a big positive. I mean, you talk about the supply coming down, but then there's the demand side of the equation. Mm-hmm. And when we look at this, I mean, we have an office REIT in our portfolio, and they keep talking about leasing is great, leasing is great. Leasing is so good, in fact, that they had to pull back on returning capital to shareholders because they have to redo all of their tenant improvements because their buildings are so full. Yeah. And it's a good short-term problem, because it's like, well, we need the capital to invest in our properties so that we can fulfill our leases. But then think about that. Once the capital is implemented in there, you do the tenant improvements. Now you have like a 7-10 year lease in there, just cash flow coming in. So, I mean, the demand seems to be very, very strong when listening to our office REIT in our portfolio. And I know it's one that we are very excited about long term.
Yeah, and I believe the office has a valuable place in business, and we have continued to see more and more companies implement return to office mandates. Remember during COVID, it was like, that's never going to change. I go, no, it's going to change. Believe me, just wait and see. With less supply out there and demand remaining strong, we should see owners of office space benefit from stabilizing rents and increasing prices in coming years. And this is where the smart investor can do well by buying good quality REIT now. We're not saying buy office buildings, that gets pretty tricky, but a good quality REIT right now and be patient. And what's great about REITs, you collect a pretty good dividend while you're waiting for things to go up.
Yeah, many times you do. And as I said, I think the office space is going to be so interesting to watch because, again, going to drive it home, the supply and demand. Less supply, more demand. Well, that then means more in rents for the good quality. And I'm going to really enter that caveat. Good quality. I don't think you want the Class C, the Class B. You want good Class A buildings because those are very hard to come by. And it blows me away when I look at the market cap for our office REIT. I'm like, our buildings that we own through this REIT are worth way more than what the market cap is on this company. I mean, it just tells me, again, I think there's some great value there.
Yes. And also, too, office conversions to multifamily residents have generated about 33,000 apartments and condominiums since 2016. Not that many, it was what I was really looking at. It is estimated by the CBRE that each conversion on average produces about 170 units. So we do have a shortage of housing. This is one way they're trying to fix it. But 33,000 apartments, condominiums over 9 years, that's not really that many.
Well, I'm going to say yes and no because you think about now all the new development of it. So you see all the time, and we talk about here in San Diego, you're driving around, there's all this new construction of the multifamily units. Now you add in the fact that they are converting office space to residential space. That is just more supply coming online for those multifamily units. And yeah, 33,000 times 170, I mean, that's still a decent amount of units that are on the market. And there's also the fact that the developers have another 85 million square feet of office space that is being readied for conversion in the next few years. So it seems like this trend is accelerating. I think back in 2016, it was a very small trend. I would not be surprised to see the fact that as it has progressed, it's gotten larger and larger and larger because it is hard to convert office space to multifamily. It's a totally different layout. The zoning restrictions are different. So, I'm curious to see if it is going to be even more problematic for multifamily in the years ahead.
Yeah, and we'll see it. And again, I want to emphasize about Class A buildings where they have, gyms, they have volleyball courts, they have it to where, a cafe for people to go to. Where it's really, they make going to the office a good thing. And I've said back when, a lot of people are going to be working home, that's the way things are. It's like, no, we are very social beings. We like to be around people. We like to, talk, have fun. I mean, and you go to the office and, yeah, you're there to work, but still it's nice to socialize.
Yeah, nice to socialize. And I do think, looking at office versus multifamily, I mean, being value investors like we are, I would definitely bet on the office space. I mean, you look at the valuations for multifamily. I haven't looked at apartment complex one in a while, but I think they were trading at multiples in the 20s based off FFO. You can find good office REITs for 10, 8 times. I mean, you can find some really great values here. You just have to be careful because I think you buy the wrong ones in the wrong markets with bad buildings, with short-term debt coming due. You could really hurt yourself in that space, but I think a smart investor can do well in the office space.
Well, that's what we always say. Before you buy any investment, invest in anything. It's 10, 15, 20 hours of research. You can't say, oh, that's good, I'll buy it. Now, again, we try to point in the right direction here on the Smart Investing Show, investment-wise, but we do tell you to do your research to understand it. Let's talk about the Facebook scams. They're just out of control, and there's no way of tracking the exact number of scams or the dollar amount lost from scams on Facebook and Instagram. But JP Morgan Chase said between the summers of 2023 and 2024, they accounted for nearly half of all reported scams on Zelle. I was like, wow, that's a lot.
Yeah, I mean, it is kind of interesting. I see scams all the time on, YouTube or like the comment section. I'll see people like, oh, I lost my crypto wallet. It's like, okay, we're going to delete that one, mark it as spam. Or, I do see them on Facebook and Instagram, and it's just like, I hate to say it, but you're like, how do you fall for that?
I know a few people that like, I can't believe I did that. It was like midnight, and what was I thinking? I wasn't thinking. I was half asleep, and I did it, and I lost, $500, and it's just like I tell people, anybody talking, it's like, always be critical. Yeah. It's like, nope, that just doesn't make any sense. Delete it, be done with it.
Yeah, and I think I was less surprised by that number. I was more surprised by this number. An internal analysis from 2022 found that 70% of newly active advertisers on the platform are some form of scam or low-quality products, and that's on Meta, Facebook, Instagram. That is a big problem when you think about that. And it makes me almost question, too. It's like, well, how much of Meta's advertising revenue is at jeopardy if it's truly coming from these scam artists?
Well, because again, you said 70% of newly active advertisers, so those new ones coming on, are platforms for some type of scam or low quality products. I mean, that's frightening.
Yeah, and I would venture to say, I mean, Meta does do over $160 billion in advertising, but the thing I look at is I bet you that 70% new that came on, they're probably very incremental in terms of the dollars. I mean, you look at like a Coca-Cola, you look at, the big players out there. I don't know why Coca-Cola was the first that came to mind, but it is. The big companies are probably spending much more lion's share of the amount of marketing dollars of that 160 billion. That 70% of newly active advertisers that are scams. I mean, they're probably spending, I don't know, $2 million. So it's not like it's a huge percent,
right.
But I would be very curious.
And it's not 70% of all the advertisers. It's new ones coming on. And that is a concern on the growth of the business, because if your new advertisers coming on, about 2/3 are not doing well or having good products. That could be a trend that's not good for Facebook. You did mention the $160 billion advertising, but also, too, in the Wall Street Journal 2024 discovered documents, and this one is just terrible, that can be hit, advertisers can be hit with anywhere between 8 to 32 automated strikes for financial fraud before the accounts are banned. So, I mean, that's a lot of fraud. Like,
32? Yeah.
32 times. I mean, you do it once a week. That's more than, half a year.
Yeah.
And you keep going and go. How many people can you rip off on that? I mean,
Yeah.
It's just, yeah.
Well, I mean, you have to think about the reason maybe Meta's a little bit hesitant to do it. Obviously, they don't want to put restrictions that could prevent growth in their ad business. I mean, That is their moneymaker. That is the gravy that allows Mark Zuckerberg to go out there and put more money into AI, to put more money into, gosh, I forget his other bets that he had, just the virtual reality basically stuff. The what did he like? Like the goggles, and I mean, he has so many other things that he is interested in outside of Meta and Instagram, but that is what is allowing him to do these other bets, is the fact that advertising brings in such high margins, such strong revenues.
Yeah, those goggles that you put them on, you get all dizzy when you...
the virtual reality. Gosh, there's another thing that I just never understood when, we were going to live in this virtual world. I can't remember the name of that, but I'm drawing a blank on it.
Yeah, I can't think of it either, but it's not what I want to be doing. Meta has argued in court that it's not their legal responsibility to deal with the issue of all this problems they're having. Section 230, which comes up a lot, you hear that a lot, I know Trump's brought it up many times, in the U.S. telecommunications law, relieves platforms like Facebook and Instagram from the liability of users who create their own content. That's the difference, because all their content comes from many different people. They're not creating it. These other people, and they say, hey, it's not our fault. We're not doing the content.
Yeah, I mean, it is maybe a good safeguard, but I do wonder if that should be challenged, especially when you look at this. I mean, this kind of blew me away, but it is being tested by an Australian mining billionaire because Facebook failed to remove fraudulent investment advertisements that used his image and AI cloned voice. I mean, that's like somebody essentially stealing our content or stealing our likeness and being like, invest with Wilsey, and then they use some other platform to direct that to. I'm like, how is that legal? That should not be legal. I mean, that is definitely something I hope he wins.
Yeah, I hope he does as well, because that is kind of frightening there. And I would have to recommend that people stay away from using Facebook or Instagram for buying from advertisers on their platforms, because you could be dealing with someone from China, Vietnam, Philippines have stolen pictures, or familiar companies. We've seen this happen, that you think you're dealing with, but it even includes the address. And sometimes they can just put a dot in a different place, so you think you're dealing with UPS, but it could be UPS dot or UP.S.
Yeah.
You don't recognize that, and all of a sudden you just sent money to some fraudulent company. It's so easy to scam people.
Yeah, you got to be careful. I know we're going to move on here, but I just remember the word. It's metaverse. That is the other place.
Metaverse. That's right.
Metaverse. Gosh, I don't know why it took me so long to remember that. But anyways, we got to move on to Salesforce because we're going to run out of time.
Oh, okay, yeah. I forgot. See, a week gone. I forgot that we do Salesforce at the end here. So let's look at Salesforce. Their symbol is CRM in the industry of software applications. We do see short on the shares is only 1.4%, so not many people shorting the stock. I thought maybe the pullback would be a buy here, but right now the PE ratio on the last 12 months is a 43. That is below the industry at 89.8. Price to sales 6.9 versus 7.1. Price to book value 4.3 versus 7.3. And price to cash flow checks in at 20 versus 33. They do have a PEG ratio looking pretty good of 1.3 versus 14. Now, their earnings over the last year did climb by 14.9%. That is better than the industry at 10.8. Sales are up 8%, not as good as the industry, up 10.6. The analysts do give them a 5-year earnings per share growth rate of 18.7%, almost 3 times the industry growth rate at 6.7. Now, they do pay a small dividend as 0.6%. Surprise, the payout ratio is 25%. So as small as that dividend is, they do use 25% of the earnings to pay that out. That's a little bit lofty for me. Well, I was surprised there. Balance sheet, current ratio 1.1 versus 1.9. Debt to equity, very good. 0.2 versus 0.5. Not much debt on the balance sheet. Do have a lot of intangible assets, so 56.1 versus 35.5. We do see a net profit margin, 16.1% versus 10.5. So for every dollar they bring in, they keep about 16 cents off that dollar. Return on equity looking okay, 10.2 versus 15.7. Return on invested capital, 8.6. And free cash flow is very good, though, $12.6 billion versus $2.9 billion. Jace, what do you got?
As our current price here for Salesforce is $274.51. Again, their ticker symbol CRM. The 52-week range, $227.77 is the low. The high here, $369. So that's why I know you say you're a little bit disappointed on the valuations, even with the pullback. And I'll kind of double down on that disappointment, because if we go forward to this January 2027, I see estimated earnings per share here of $12.63. I mean, it gives us a target sell price about $209.66. So it still trades over 21 times those future earnings. I mean, it's expensive. And, I got to say, it seems like they're almost going back to their old ways. They just announced a purchase of this company called, I never even heard of it before, Informatica, for about $8 billion. So,
wow.
A decent size acquisition here. And a couple analysts really didn't like that. They downgraded the stock over concerns with execution risks if the company continues to acquire other businesses there. It's hard to integrate companies into a company here like the size of Salesforce. So, I definitely don't like it given the current valuations for Salesforce.
In my 40 years of managing money, I have seen where companies say buy, and then like 5-10 years later, they got to divest things, so it didn't work out. Yeah. And that's what worries me about a company doing so much in the acquisition side. It could cause problems down the road.
And I still don't even really know what Salesforce does. I know they have the CRM, and we use Redtail for our personal CRM system, and we used Salesforce years ago. But I know they are in the agentic AI is what they call it, where they have the agents to do the AI. I don't know how that all plays in. So if you held this, you have to know what the growth is for this potential business, given the lofty valuations.
What do they really do? Is what you want to know. So, all right, we're going to take a quick break here. When we come back, we're going to talk about Gap, Wells Fargo, and Steel Dynamics. Stay with us. You listen to the Smart Investing Show with Brent and Chase. Alrighty, welcome back to the Smart Investing Show. Gosh, we got so many things in the first half of the show. I forgot to promote the newsletter. The Smart Investing newsletter goes out every Friday at 5 o'clock. Topics we didn't cover was Sell Gold, Buy Platinum. Computers in our brain may not be that far away, and the growth in gambling might become a problem. If you want that newsletter, again, go to our website, smartinvesting2000.com. Again, smartinvesting2000.com. Free newsletter in your email. Friday, 5 o'clock every time. All right, let's talk about financial planning. For that, we turn to our CFP, our financial planner, Harrison Johnson, talking about retirement savings rate hit record high. How do you compare? I
think I compare pretty good. But
I know you do.
I was surprised by this because the average 401k savings rate has hit a new high. It's up to 14.3%, which includes the employee and the employer match that you're getting. A good rule of thumb that a lot of people go to is the 15%. So at 14.3, it's very close. And I was surprised it was that high given, inflation numbers and with consumer confidence and where that's at. So wanted to bring that up. I thought it was an interesting point to bring out.
And it's amazing. You mentioned 14.3%. I always wondered too, the savings rate does include 401ks. I guess it does.
In this case, it does, yeah.
Mm-hmm. But I always told people, if you were to put 10% into your 401k, get the employer match, invest wisely, you're going to do pretty well. You're saying it's 14.3% with employer match. That's pretty good.
It's pretty good, actually. And, obviously that number, the benefit of that can vary based on your income and how long you're working and when you want to retire and all those types of things. For example, to your point, Brent, for somebody who's younger, if you start saving sooner, it really cuts down how much of your income you need to save. So if you start your career in your early 20s and then save as little as like 7%, including the match, in many cases that would be enough to be able to get you to retire and have a level of income that covers what you need. However, if you wait until your 40s, for example, then that savings rate is close to about 25%. So it's a whole lot more the longer that you wait. So the earlier the better. But with the most common matching system out there with employers is the employee has to put in 5% and then they get a 4% match. That's the most common one, which is 9%. So, if you start doing that right away and the money is invested in growing correctly, then you should be totally on track and be able to potentially retire ahead of time.
Well, and it's exactly kind of what you said. If you put in 10%, your employer's putting in 4%, there's your 14% number. I mean, it's kind of right in line with what you've been saying for years. So great job.
and that works. And I did on myself back when I was like probably 30. I said, okay, this is why I want to have my 401k by the time I'm 65. I blew way past that because I did what I was supposed to do and I invested wisely, which is very important because some people, you don't want to be too conservative and put everything in the money market, nor do you want to be too aggressive and put everything into these, the next Facebook or the next, Tesla, stuff of that nature.
Yeah, you definitely need the growth. If you sit in a money market for 40 years, you're not going to be able to retire likely. So you need the growth, but it's so important to get that started sooner. And what I try to recommend people to do is when you start working, put as much money as you can into that 401k. People ask, well, how much do I need to save? As much as you can. You're never going to regret having more money. And the benefit of that is if you can save a little bit more earlier on, it really cuts back how much you have to save later on when life gets more expensive. Later on, you have kids, you have a mortgage. Just to exist takes more money. So if you can front load your savings and then allow that savings to compound and do the legwork itself, it really cuts down how much you have to do while juggling all your other bills that you might have as you progress through your career.
I'm curious. I know the report you looked at didn't give the median savings rate, but I would be curious what that would be because I'm just kind of thinking somebody makes $100,000, let's say, and they're really far behind on their savings. They're like, oh shoot, I need to max out my 401k. Well, that'd be about a 30% savings rate if they're over the age, 50 and a half. Plus, then you get the match. I mean, that's a 34% savings rate that they're having to do. So that really skews the average. Mm-hmm. I think average is obviously important, but I'd be curious where the median would be because I know a lot of people, especially in our demographic, that are like, oh, what's the match? Oh, I'll just do that. Mm-hmm. And that's the maximum that they'll do.
Right. And I mean, if you do that, if you start early enough, you still should be okay. But a lot of people, don't start earlier enough. Or another thing that you see is, well, I don't get a match, so I'm not going to put anything at all. Don't do that. It's your money. You want it to grow, even if there's no match. It's okay.
And Chase, you brought up median. That it used to be the average all the time. I'm seeing more and more analysts using the median because it's so much more telling. Yeah. Because you're right. I mean, you can have these people. The averages are putting in so much, it brings up the average. When really it's not true. The median is the one that's right in the middle, and that helps a lot. The other thing I want to say, too, was I hate when I see people doing the 401k, and then they leave their employer, they don't roll it over. Oh, I'm going to take it and go on vacation. I'm going to do this. Like, gosh, I hate seeing that or using it for other things. That's money you should never, ever touch.
Yeah, we mentioned that last week in the show.
Oh, did you really? Who did that? Did you do that? I know Chase would never do that.
Well, not that we did it. We're just saying during the show we talked about it because it's like,
I wasn't here.
Well, Harrison made the bold comment that most people are stupid. I think you said that. I was like, oh.
Well, and I'll clarify that. What I meant by that is we see people who leave a company.
Wait a minute. I think your phone's ringing right now. People want.
If you leave an employer and you're not at retirement age yet and, they have some money in their 401k and they just want to withdraw it. So they pay the taxes, they pay the penalties. That is stupid. Do not do that. Having a 401k is a great thing. If you put money into it, you let it grow, that's great. It's a phenomenal tool. But I meant, and I want to clarify this, if you take the money out and pay taxes and penalties on it just because you want the cash, that is not a smart thing to do.
Yeah, I try to refrain using the word stupid, but it is stupid to do that.
When I want to be blunt, I'll say, yeah, that's stupid. When I want to be nice, like, well, that's a silly thing to do. Makes a little bit nicer sound.
Yeah, it's like when you take money from the 401k, you're basically going to lose half. And it's like, stupid.
In California, yeah.
And the compounding you're missing out on.
Yeah.
It's just, I just don't get it. But
So it doesn't take much, 10% or, that 15% number with the match, or if you start early enough, it's less than that. It doesn't take a lot. I think retiring is a lot more difficult than it's made out to be, and it's because people do things like that. They withdraw money when they shouldn't. They don't save as much as they should when they should. They don't invest in the right things. But if you can be consistent through, a decent retirement can be created with a good 20 years. It doesn't necessarily take 40, 45-year career to be on track for that. You just have to be smart and, kind of do the right things along the way.
right. Be smart, not silly.
Not silly, yes.
Well, Harrison, thank you very much. Again, that is Harrison Johnson. He is a CFP with Wilsey Asset Management, our financial planner. You want a free consultation with him, give him a call at the office, 858-224-0004. Again, that's 858-224-0004. 0004, or go to the website smartinvesting2000.com. Again, that's smartinvesting2000.com, and he will use the word silly, not stupid. I've done the same thing. Sometimes they just come out
You
like,
just get so passionate about it
I
because
know
it's like it just costs you so much money. And it's so funny. We'll have people that'll call us, and we manage 401ks for businesses, and we'll talk to people, and they leave, and you're like, hey, do you want to move this over to your new 401k? Move it to, no, just send me the cash. And it's like, I wouldn't do that. No, that's going to cost you like 50%. That's fine. What are you doing?
All right. Well, let's give them some reasons not to, and we'll look at some companies here that maybe you say, gee, I shouldn't take my money from the 401k. I should actually invest it in these companies. Next one we're going to look at is Gap, which is a clother. I think it is called The Gap is the actual name for it. It's funny, the screen here doesn't say The Gap, but I looked at someplace else, it did say The Gap. They're in the apparel retail. They have 11.3% short on the float side. So a lot of people think this is going to drop dramatically. Only 64% institutional ownership, so a lot of individual people hold this stock. A good start here, though. The PE ratio is 9.5 versus 14.5 for the industry. Price to sales looks good, 0.6 versus 2.1. Price to book value, 2.5 versus 6.5. And then we do have price to cash flow, 6.4 versus 16.5. And you want these valuation ratios lower than the industry average. No PEG ratio, though, so you can't see what you're paying for the future growth of the company. Now, their earnings over the last year were up 27.8%. Double the industry at 14.3. Could be a problem with the sales, though. Sales are only up 1.1% versus 6.9. We do not see a 5-year growth rate from the analysts. I guess they just don't want to predict that out at this point in time with the tariffs maybe. They pay a decent dividend, 3%, and only use 26% of their earnings to pay that out. Remember, Salesforce used about, 20%, about 25, I think it was. We do see that, let's say on the balance sheet, quick current ratio, 1.7 versus 1.8. That means they got good liquidity. The debt's a little bit high. It's 1.7, double the industry at 0.8, so I would like to see that lower. Generally, if it's above 1.4, we say we won't buy the company, but you might want to look into a little bit deeper. We do see net profit margin 5.8, below the industry at 8.6. Return on equity, very good, 26.5. Free cash flow is only $879 million versus $3.8 billion for the industry. Not looking too good here for Gap.
Yeah, well, Gap, I was kind of curious on their brands because, it's not just Gap. Like, I go to the mall, and I'm like, I don't know the last time I went to a Gap. They also have Old Navy, Banana Republic, and Athleta. Frankly, I don't shop at really any. I used to shop at Old Navy, actually, when I was in college.
You don't shop much at all.
Yeah, I don't really shop much at all either. But Old Navy is actually over half of the Gap sales. They should change their name to Old Navy, not the Gap.
and I think Old Navy became very popular a few years ago. It took off.
Well, it's kind of like more discounted, I guess. So I think they're kind of the Gap. I don't know essentially what type of products they sell, but Gap is actually only about 20% of their business. Banana Republic's about 12%, and then their new athleisure brand Athleta is around 10-ish% as well. So I was kind of surprised by those numbers. I did not know Old Navy was that large a part of their business, essentially. Yeah. I was going to put it around maybe 25-30%, but it's not, over half. Looking at the current numbers for Gap, though, it is a current price of $21.95, 52-week range. The low here is $16.99, and the high is $29.29. I do know the stock was flying quite high. I know some of the analysts really like the new CEO. I'm blanking on his name here, but he's got a good kind of rating, a lot of excitement around him. I know he came from Mattel, but the problem is they actually reported earnings here recently, and the stock plunged about 20%. This came even after they beat earnings. They beat sales. But you talked about uncertainty around tariffs. That is really what got them. They didn't include tariffs in their guidance. They did say they think tariffs could hit operating income by about $250 million to $300 million. They're hoping to offset about half of those costs, but they didn't include that in their guidance. Crushed the stock. Again, a 20% decline for a business of this size that's a rough day on the market.
So they didn't say anything about tariffs? They just...
No, it's kind of funny. They didn't include tariffs in their guidance for sales and earnings, but they said tariffs will likely have an impact of this amount on our business. It's like, well, why didn't you just include that in your guidance? Then it's kind of a strange situation. But I was also kind of surprised by this. The big thing I always look at with these companies is how much of the business is China. And this is according to ChatGPT. So I always kind of throw out this disclosure here now because, there's still some questions around how accurate it is, but it pulls in the data pretty quickly for me, especially on air. But looking at it, as of October 2024, only about 7.2% of its apparel was sourced from China. It was the company's sixth largest supplier after Vietnam, India, Indonesia, Bangladesh, and Sri Lanka. So, that is something that I think is really helpful for Gap long term because I think China is, again, going to be the hardest one to negotiate with, especially with that tariff rate. And the CEO did say that less than 10% of the company's products, again, were sourced from China and plans to reduce that figure to under 3% by the end of 2025. So they're really trying to shift away there.
And, and I haven't heard talk about it recently, the last couple of days or so, but the International Trade Court that said the president doesn't have the right to do what he did, has to go to the Supreme Court. That really takes away your negotiating power. Supreme Court has to decide that quickly. Yeah, I hope they do not decide against it because that would just throw everything to a tizzy. But they need to decide because it's kind of hard to negotiate. You're like, well, maybe they can't do it.
It would frankly send stocks up short term if they throw out the tariffs. It would send those companies with China exposure probably up pretty quickly.
True.
Now, I'm not going to be for that, but again, just kind of putting it out there. that is the positive from it, I guess.
And I'm looking at the long game, not the short game. So,
yeah. But looking at the current price, again, versus the target sell price, you go out to January 2027, estimated earnings per share here, $2.37, gives you a target sell at $39.34. Stock trades around 9 times future earnings. It's intriguing based off the valuation here for the Gap. I don't shop there, so that always worries me just a little bit because I'm like, who is their target customer? Is it growing? Is it not growing? It's kind of funny we talk about Abercrombie and Fitch. Their stock has been phenomenal. I don't shop there either, but I'm like, shoot, wish would have bought that one.
And I think it depends a lot on Old Navy. So you and your wife, I know you got a baby coming.
And they got some good kid clothes. I don't know.
Yeah, good. I know they do, but also too, kind of check it out and see what's there. But did look at the debt. The debt a few years ago was a $5.5 billion. Now it's down to $4.8 billion. So they are trying to pay that debt down to some reasonable level. So, all right. Should we?
So would you buy, sell, hold? Where are you at?
That debt just kind of worries. And we have our discipline. We won't buy a company with more than 1.4% debt to equity, and they're at 1.8.
Yeah. So even with the valuation, I think you're right. Just definitely not worth it. Especially the risk in retail is so high.
Yeah.
High debt in retail, I think, is the scariest thing because all of a sudden you have a little bit of time out of fashion. That's just enough to send you over the edge and put you into bankruptcy.
And this is always difficult because there's things I want to buy where they look pretty good. This looks pretty good. I want to buy it, but you can't break your discipline because once you break your discipline, you have no discipline. Yeah. And you got to stay to it. Maybe you'll miss some things, but that will save you more than not if you stick to a good discipline of being safe when you're investing.
It's kind of like, if you're on a diet and you're like, I'm just going to have one bite of a cookie. There's no way I can have one bite of a cookie. I need to have the whole cookie.
Yeah, and then well, one more won't hurt. Oh, the bag. Oh, shoot, I ate the whole bag. So, stay disciplined when it comes to investing. You want to talk about Wells Fargo?
Yeah, let's talk about Wells Fargo.
Okay.
I think this is an exciting one, and
yes,
I think we should disclose we do actually own this one in our portfolio. Yeah. So, but I thought this news was so important, we really wanted to hit this one this week.
Yes, let's talk about Wells Fargo. Their symbol is WFC, and the bank's diversified. Shares float about only 1.3%, 78% institutional owned. PE ratio is 13.7 versus 9 for the industry. Price of sales 3.2 versus 2.8. Price to book value 1.5 versus 1. And price of cash flow, 62.9 versus 19.8. So the value ratios are higher than the industry, but the PEG ratio, which tells what you're paying for future growth, is only 1.1 versus 4.7, so that's a positive. Now, their earnings, and again, you'll probably talk more about the asset cap they had, but their earnings still grew by 15.8%, not as good as the industry at 22.2, probably because their asset cap. Sales went down 1.4% of last year. Industry was up 5.1, but the 5-year growth rate for Wells Fargo, I believe, because the asset cap has been lifted, 12.2% above the industry at 8.2. Now you get a decent dividend, 2.1%. They use 27.5% to pay out that dividend. Didn't they say they're going to increase the dividend, or we haven't heard that yet?
I don't think we've got an official word yet on that potential increase, but yeah, I think the banks have their stress test, so I think that normally comes out in July-ish, if I'm not mistaken.
Okay, yeah, because I'm very confident they're going to increase that dividend. That was one thing
I'm sure they'll probably increase dividend and maybe stock buyback too.
Yeah. And look at the balance sheet. Again, it's a bank, so you don't have any current ratio, but the debt to equity is 1 versus 1.9. Net profit margin, 24.5, not as good as the industry at 31.9. Return on equity, 10.4 versus 11. And free cash flow, well, this is positive. It's a $4.1 billion. The industry is a negative $6.8 billion. So they've been bringing in a lot of free cash flow to actually build their business.
Yeah. I think definitely some interesting things there on Wells Fargo. Current price here, though, $76.33. 52-week range, I mean, it's performed well. The low here, $50.15, and the high, $81.50. So, again, much closer to the high than the low. Going forward, even with the increase in the stock price, I mean, valuations are still attractive. Going out to December 2026, estimated earnings per share is $6.52. Gives us a target sell price of $108.23. So I think there's a lot to like with Wells Fargo. We talk about this asset cap. I think this was huge news for the business. Reason being, they're no longer constrained, and it is so hard. Can you imagine somebody telling you, like, oh, you can't really continue to grow? Well, especially when people are adding money to your bank, you're like, oh, we have to be careful not adding money over here, adding money over here.
Can't go too much, can't add too much, yeah.
It would be such a challenge. So, I mean, think about all the costs and all the time that they had to spend on that asset cap. It was a huge burden to them. The regulatory expense, well, now that's gone. I mean, all the people that they had for the compliance department, they'll keep some on to make sure they stay compliant so they don't have the same issue from 2015. But again, the cost should decrease substantially. And also, I looked at this. I mean, everybody's upgrading them. Morgan Stanley upgraded them. Goldman Sachs upgraded them. Bank of America upgraded them. Everybody's talking about now how this, again, will allow them to grow. And I was kind of blown away by this. You talked about this a little bit this past week, but they are going to try and now regain its 2.2% point lost market share in U.S. deposits, and then the 3.3% in points of market share in loans that they've lost since 2017 because of managing that asset cap. There is not just now the opportunity for growing earnings because of decreased expenses. There's the opportunity for growing sales as well.
Right. And I do remember, I know we did a post on this as well. That's why you want to get the newsletter at smartinvesting2000.com. But also, too, during the time frame, I think it was 2019 and 2024, other banks grew their assets by, I think, 34%, I think it was. Wells Fargo, 5.5. Yeah. So they're going to be trying to get assets. They're going to be probably raising their rates. They're going to try to take money because it's nothing from the Fed now. This is all coming from the money that's out there. They've got to steal market share from other companies. Other banks and the regionals are the one that's going to have the hardest problem.
Yeah, I think so. And kind of talking about the earnings growth, though, for Wells Fargo, I mean, just a couple of these analysts, I mean, these are some pretty big numbers. One from Goldman Sachs estimated they could see 14 to 19% of earnings per share upside. Evercore, a gentleman named John Pancari, estimated combined $1.19 or about 18% positive growth on annual earnings per share benefit from the potential asset cap lift. So, I mean, these are big positives. Also, too, now this was the last kind of thing that was hindering them. The company has resolved all 14 consent orders that had been imposed on it after this issue that they went through. 8 of them removed this year. So, I mean, Charlie Scharf, he's done a phenomenal job as CEO, in my opinion.
Yeah, no, he's a great CEO. He was trained by or protege of Jamie Dimon, CEO of JP Morgan Chase, and he's just Charlie's a great CEO. So I was glad to see that he will make this grow.
And last kind of comment involving the banking industry as a whole, one thing we can't forget is Michelle Bowman was just confirmed to be the Fed's vice chair for supervision on Wednesday, and she is, I'm going to say, a big positive for banks. She did come out here and say that the influx of rules since the 2008 financial crisis merits reconsideration. She's, I think, a lot more friendly than what we saw under the previous administration. I think not just for Wells Fargo, but for many other banks, that should be, again, another opportunity for them to continue to grow earnings, which, if you can't tell, we're pretty bullish on Wells Fargo.
Yeah, and I'm sure you saw the Elizabeth Warren, the senator, this past week came out again. It's like, oh, this is terrible and so forth. But we got the banking.
If she had it her way, every bank would have an asset cap.
Oh, yeah. And they couldn't grow more than
even if they did
2%.
nothing wrong.
They would give money away. Here, just give money away. That's all you got to do. Let's move on and talk about steel companies, because big news on the steel this past week here. We do see that we're going to look at Steel Dynamics. Now, their symbol is STLD. We're going to say, well, I think I'll save that for that because I know you got some information on that. Let me give the numbers first here, I think. PE ratio, and actually the steel industry, symbol again, STLD, only 2.1% short on the flow side, 85% institutional owned. PE ratio 17.6 versus 33.4. Price to sales 1.2 versus 0.5. Price to book value 2.3 versus 0.8. And price to cash flow 12.5 versus 5.7. A little bit pricey there, but the PEG ratio is only 0.6 versus 34.6 of the steel industry. So that's showing you're not paying very much for the growth of this Steel Dynamics company. We do see their earnings. Wow, they were down 47.9%, but the industry was down 45%. Sales were down 7.4%. Industry is up 3.4%. Now, the analysts over the next 5 years give a 19.5% growth rate versus 0.9 for the industry. So I'm liking to seeing that. We do see a dividend rate of 1.5%, using 25% to pay that out. The balance sheet, current ratio, very good, 2.7 versus 2.3, not much debt, 0.5, same as the industry. We do see a net profit margin of 6.8 versus 2. Return on equity is 13.3 versus 4.7. Free cash flow, not good, though. It's a negative 157 versus 307. And return on invested capital, 9.4. If you don't give me something bad here, I might leave the show and go buy this stock. I mean, looking pretty good. What do you got?
Yeah, and what did you say the debt was again? That's always
The
obviously
debt was pretty good. The debt was, where is the debt at? Come on, where'd you go? 0.5.
Yeah,
And a big current ratio, 2.7.
Yeah, that's a nice pairing there. Current price here for Steel Dynamics, again, their ticker symbol STLD, $133.56. 52-week range, the low here, $103.17, and the high, $155.56. I'll tell you, one of the things that concerns me with these steel stocks is just the performance, and it's such a cyclical industry. But I mean, the 5-year return for Steel Dynamics, 351%. I mean, you look over the last 10 years, 506.8%. I mean, this stock has done so well, and that doesn't even include the dividend.
Yeah, I was going to say the dividend, the 5-year return is 421%. The 10-year, 647%. That's why we love dividends. We like companies that pay dividends because it really adds to your performance.
And you said, what was the 10-year?
647.
Yeah, I mean, you think about that. I said 500 for the 10-year. That's about 150% more in terms of the return, just because of a dividend that, was like 2% or something now? I mean, it's just so crazy how impactful those dividends can be. Dividend yield is actually 1.5%, so even less. But going forward, I mean, it looks good. I mean, I go out here to December 2026, $10.32, $12.32 is those estimated earnings per share. Gives us a target sell price of $204.51. So I think there's a lot to like with Steel Dynamics. The interesting thing about them in the news this past week, we did see that, again, talking about Trump's tariffs, he did double tariff rates on imports for steel to 50%. So, I mean, this is something that, he's really against, obviously, China dumping steel here in the U.S., which allows the U.S. players to really kind of sell, obviously, to U.S. companies. So, I mean, that could be very helpful to Steel Dynamics and growing sales because you're competing against less foreign steel makers.
And I did look at the debt on the balance sheet here. Long-term debt is about $3.8 billion. Unfortunately, that's higher than 3 years ago, and it's at $3 billion. So their debt is increasing, but still compared to their equity, because their equity is, let me look at that real quick, $8.8 billion. So pretty safe on that. I like this, and I believe that steel companies will do well in the U.S. going forward.
Well, and we talk about, again, if there is reshoring,
yeah,
I mean, you're going to need steel to produce those facilities, right, to build out for those companies to have these factories.
Right.
I mean, it could be an intriguing place to be investing, I'd say.
And you got the main players of what Nucor, U.S. Steel was picked up by
Nippon.
Yeah, I was going to say
And
Nikon,
it's
but
kind of a
Nippon.
weird deal, I know. I don't know the full details on it, but Trump kind of sold it as more of an investment rather than
Right.
a full-out buy. But all I know is U.S. Steel went up to that target sell price of where Nippon Steel offered to buy them. So it appears that U.S. Steel will no longer be trading on the stock exchange, would be my guess.
Yeah, but Steel Dynamics is one you can still pick up and benefit from that. We only really have 3 major steel companies.
Well, now only 2.
But Nippon did say, they did say that they're going to keep everything here in the U.S.
Yeah, but I don't think you can buy U.S. Steel
No,
stock.
you can't buy the stock. Yeah. So, all right. Well, thank you for listening to the Smart Investing Show. It is for informational purpose only and should not be used as investment advice. If you would like to discuss in more detail your investment needs or have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-224-0004. Again, that's 858-224-0004. Or go to our website, smartinvesting2000.com. Again, smartinvesting2000.com. A lot of great information there at the website. Sign up for the newsletter. We'll be back next week right here on the Smart Investing Show.